This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Welcome to another edition of the Wise Investor Show podcast. Matt Anderson. I'm a financial planner with the Wise Investor Group in Reston, Virginia. Thank you for listening today. We're going to be talking about gifting today, and we're going to start out by discussing some of the basic rules around gifting to individuals, and then we're going to get into some of the strategies that one might use or vehicles that one might use for charitable gifting, including whether to give cash or stock, whether to utilize a donor-advised fund or a charitable gift annuity, or a qualified charitable distribution from your IRA. Now, I'm going to keep the discussion at an elementary level. We're not going to get into the more complex gifts involving irrevocable or charitable trusts. So without further ado, let's get into it. So let's start by talking about the annual exclusion gift limit. In 2025, you can give $19,000 to anybody. If you give $19,000 or less, you do not have to report the gift to the IRS. Gifts to U.S. citizen spouses, qualifying charities, or payments made directly to educational institutions or medical providers are exempt from this limit. So if you want to preserve your $19,000 gift exclusion, it's good to pay medical expenses and educational expenses directly to the institutions instead of giving the money to the person first. In addition, we have a lot of clients who help out with daycare expenses for their children. Daycare is generally considered custodial care and not tuition and is not exempt from the annual exclusion gift limit. Just an FYI there. Married couples filing jointly can elect to split their gifts and give $19,000 each to any person for a total of $38,000. If you elect gift splitting, you do have to report that to the IRS on Form 709. So any gifts made over $19,000 will need to be reported on Form 709. Now, reporting is the duty of the giver. The person receiving the gift has no reporting requirement. If a single taxpayer, the amount over $19,000 will reduce your lifetime gift exemption. And if a joint taxpayer, the amount over $38,000 will reduce your lifetime gift exemption. The lifetime gift exemption in 2025 is currently a whopping $13.99 million per person, or $27.98 million per couple. So what this means is if you give more than $19,000 or $38,000 as a couple, you do not trigger any gift tax, nor does the person you are giving to have a taxable event. In other words, you could give $19,000 plus an additional $13.99 million to somebody and not pay any taxes. And this is important to understand because from my experience, it's the most misunderstood part of gifting. The giver does not pay any tax, and the person receiving the gift does not pay any tax. Now, let's just use an example to hammer home this point. If you gift $30,000 to one person in 2025, the first $19,000 is covered by the annual exclusion, and the remaining $11,000 is reported on Form 709 and reduces your lifetime exemption to $13,979,000. Okay, I think we're clear on the basic gifting rules. So now let's talk some strategy. A question I often get is whether it's better to give cash or securities to someone. Like most things, the answer depends on a number of factors, and I'll break these factors down by tax implications, liquidity and use of the money, and estate planning considerations. So the tax treatment of cash and securities gifts differs primarily in capital gains considerations. When gifting cash, there are no capital gains tax implications for you, as cash does not appreciate or depreciate, and there are no capital gains tax implications for the person receiving the cash. Now, when gifting securities, you do not realize capital gains at the time of the gift, meaning any appreciation in the securities, for example, stocks you purchased at $10,000 that are now worth $30,000, is not taxed until the recipient sells them. Now, this is important. The recipient inherits your cost basis. So that would be $10,000 in the prior example. Now, when they sell, they pay capital gains tax on the difference between the sale price and the inherited cost basis. So, gifting appreciated securities allows you to defer capital gains tax, which can be significant if the securities have substantial unrealized gains. However, you have to be aware you're shifting the taxation of the gain to the recipient when they sell the security. Now, let's move on to liquidity and practical use of the gift by the recipient. Liquidity is a critical factor, especially for the recipient's immediate needs. So cash provides immediate liquidity, allowing the recipient to use the funds for any purpose without delay. For example, they've got bills to pay, or they want to invest the money elsewhere, or just for spending. And this is ideal if the recipient needs funds for short-term expenses or just prefers not to have to manage investments. Securities may require the recipient to sell the assets before they can use the funds, which could involve transaction costs. And there are timing considerations. For example, what are market conditions at the time of the sale? Not to mention the capital gains tax that we discussed earlier. However, if the recipient plans to hold the securities, they can benefit from any future appreciation, potentially increasing their wealth over time. In addition, transferring securities typically involves filling out forms for a brokerage account, which can add a layer of administrative effort compared to cash. Bottom line, if the recipient is inexperienced with investing or prefers immediate access to funds, cash might be more practical. And conversely, if they're financially savvy and they have a long-term time horizon, securities could be advantageous. Now let's talk about the estate planning considerations. Gifting cash does not directly impact your investment portfolio or estate in the same way as gifting securities. However, it can still reduce your estate value if the gift is large, as that cash is removed from the estate. Gifting securities, on the other hand, can help reduce your taxable estate, especially if the securities are expected to appreciate further in the future. So by gifting during life, you remove the asset and the future appreciation from your estate, potentially lowering estate taxes upon death. Now, a big consideration you must weigh is if you were to leave the securities to the recipient upon death, the recipient will receive a stepped-up cost basis to the fair market value at the time of death. This means they pay capital gains tax only on the appreciation that occurs after your death. The tax savings from not having to pay capital gains on the sale of the security could be very large, depending on the size of the holding and the size of the unrealized gain. However, this requires waiting until death, which may not align with your current goals. We're going to take a little bit of a pause here, but on the other side of the break, we'll pivot and talk about giving to charity. We'll get into some of the strategies and vehicles that can be used to accomplish your charitable giving goals, and we'll be back in a minute.
Higher inflation and higher interest rates could be coming, but bonds are still beating stocks so far this year. How should we think about positioning for stability and cash flow in a more volatile world? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
So now we're going to pivot to charitable giving. Similar to giving to individuals, you have the option of giving cash, securities, or another asset like real estate. Gifts to charity are reported as an itemized deduction on Schedule A of your tax return. If your itemized deductions are less than the standard deduction, you will not receive a tax benefit from your charitable giving. And we'll talk more about this a little bit later in the show. The main difference between cash and stock has to do with the capital gain considerations. Giving cash is pretty straightforward with no additional tax considerations beyond the deduction itself. The deductibility of securities is a little bit more complicated. We have to know whether the stock has an unrealized gain or loss and whether or not the security has been held for over a year. Now, what if the security has an unrealized loss? Well, if held for a year or more, you can only deduct the fair market value, which is less than your basis. In that case, it would be better to sell the stock first, realize the loss, which can offset other gains, then donate the cash proceeds. If the security has been held for less than a year, you can deduct your cost basis. For those giving large gifts to charity, you must be aware that the deduction may be limited to a certain percent of your adjusted gross income. If giving cash, the deduction is limited to 60% of your AGI. If giving securities, the deduction is limited to 30% of your AGI. Any overage can be carried forward for 5 years and be deducted in the same way each year. This is especially beneficial for those in the highest tax brackets, where capital gains taxes may be a combined 30% or more when you add in state tax rates. It's also a good way of trimming a concentrated position. Now, once you have determined whether to give cash or appreciated assets, the next question is how to gift to the charity. First is outright giving to the charity. This is very simple and straightforward, and a good idea if you know the charity you want to benefit and you aren't giving to multiple charities. Cash or securities can be electronically delivered to the charity right out of your account. Very simple. Now, you may have seen some of your charities pitching a charitable gift annuity as an option. Now, this would be something to consider only if you wanted some income from the gift. However, there are several drawbacks. Number one, the value of the gift will be reduced by the annuity you receive. Part of the annuity income is taxable. The charity benefits only after your death, which delays the impact of your gift. And lastly, payouts tend to be lower than traditional annuities. So if income is a consideration, you'd probably be better off purchasing just a traditional annuity. In my opinion, these vehicles should be used only in very limited situations, as most people have already made the decision to part with the money or the asset and are looking for the highest deduction possible. A donor advised fund is another vehicle you can employ for your charitable giving, and here's how it works. You contribute assets to a donor advised fund, and it's a fund that's maintained by a public charity. Almost every investment company now sponsors a donor advised fund, including Raymond James, my firm. You receive an immediate tax deduction. The assets grow tax-free, and you can recommend grants to qualified charities over time. Now, the benefits of a donor advised fund are numerous. You have flexibility to recommend grants now or in the future. This is ideal for strategic giving, or if you need a tax deduction now, but you're not sure of the exact charities that you want to support. Donor advised funds can hold various assets, including cash, securities, real estate, and non-publicly traded assets without incurring capital gains tax. And growth inside the donor advised fund is tax-free, as I said, potentially increasing the impact of your donations over time. You can also involve family in the giving process by naming successors who can direct giving should you pass away. It's also pretty cool, in my opinion, to be able to name the fund. For example, in my case, the Anderson Family Giving Fund. Although available to everyone, even very wealthy individuals like donor advised funds because the grants can be anonymous. Lastly, donor advised funds are very useful when employing a bunching strategy for your charitable giving. So let's say you're just under the standard deduction, so you won't receive a tax benefit for your giving. You can bunch your charitable giving into 1 year by contributing to a donor advised fund. Now you can itemize your deductions and receive a higher deduction for this year, and then you can still make grants to your charities over the next couple years in the same way you would have, so that the charities aren't impacted from a down year of giving. Itemizing can also have a large impact on your state taxes. So most states, especially in Virginia and Maryland, require that if you take the standard deduction on your federal return, you must also take the standard deduction on your state return. Now, the standard deduction in many states is much lower than the standard deduction on the federal return. For example, in Maryland, the standard deduction is only $3,350, $6,700 for joint filers. This compares to $15,000 and $30,000 for couples for the federal standard deduction. At an almost 9% combined state and local tax rate, that is $1,000 to $2,000 in tax savings by doing this strategy, in state tax savings. Now, there's a couple things to be aware of. Some donor advised fund sponsors may require distributions every 2 years or minimum grant amounts. And grants are typically limited to 501c3 public charities, not private foundations or individuals. Now, lastly, I want to talk about qualified charitable distributions from your IRA accounts. If you are at least 70 and a half years old, now this means not in the year you turn 70 and a half, but you're actually 70 and a half, you can transfer up to $108,000 per individual directly from your IRA to a qualified charity. Married couples can each distribute $108,000 from their respective IRAs. Now, the distribution counts towards meeting your required minimum distribution and is not counted as taxable income. The qualified charitable distribution is best used, in my opinion, for those who are subject to required minimum distributions already. Because it counts towards meeting your RMD, it has the impact of reducing your taxable income dollar for dollar, since you would have to pay taxes on the RMD income from your IRA. The additional beauty is that it reduces your adjusted gross income, which may mean lower Medicare premiums, lower capital gains taxes, or other things that are dependent on your adjusted gross income. The other great thing is that you get the tax benefit of your charitable giving without having to itemize your deductions, making it beneficial even if you take the standard deduction. Now, although most beneficial for those already taking required minimum distributions, it can be beneficial even if you aren't RMD age yet. If you have a large IRA, qualified charitable distributions have the impact of reducing future RMDs by reducing the value of your IRA. Now, although you won't get an immediate tax benefit because there's no RMD income to offset and you don't itemize the qualified charitable distribution, you will reduce future taxable income. Now, a couple of important points for consideration. QCDs are only available for IRAs. not other retirement accounts like 401ks or 403bs or your TSP. So to take advantage of the QCD, you would have to roll over money from these plans into an IRA first. Qualified charitable distributions cannot be used to support private foundations or donor-advised funds, although a donor-advised fund can be named as a beneficiary of your IRA at death. They are also limited to qualified public charities, which may not include all of your desired recipients. Well, that's it. I hope this was a good lay of the land for further understanding the gifting rules and the strategies and vehicles available for meeting your gifting objectives. As always, should you want to discuss anything related to your investments or your financial planning, please go to our website at thewiseinvestorgroup.com and send us a message by clicking on Contact Us. We would love to hear from you. I wish all the dads out there a very happy Father's Day this weekend. Be sure to show them some love. And to everyone, I wish continued wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.